Hi, I'm Seth Freudberg. I'm the Director of Options Trading here at SMBU in Manhattan, and I'm the head trader of SMB's Options Trading Desk. So today I'd like to talk to you about what I would call a dopey options concept. There's certain things that kind of annoy me in the options world, to be honest with you, as far as concepts that are offered to people. And I like to debunk them now and then because I don't think that people should fall for these sort of gimmicky kinds of concepts. And I think that it's important to be educated to stay away from get-rich-quick schemes, etc., in the options world, because there is no such thing, at least without taking enormous risks. So let me give you an example of a dopey concept in options trading. A lot of people are attracted to options trading because they don't really have enough money to buy 100 shares of a stock, but they do have enough money to buy a single option which represents 100 shares of stock in terms of the movement of that stock. And so you'll very often hear sellers of options education or even individual traders say, gee, I love trading options because the most I can lose is the cost of the option, versus I could theoretically lose 100% of the cost of the shares. And they say, however, think about the leverage I'm getting. If I spend a little bit of money and the stock goes in my direction, then I could get a return of 1,000% or more. And of course, that's theoretically possible. Here's the problem with that thinking. And the problem goes like this. When somebody says to you, the most I can lose is the cost of the option, what they're really saying to you is, the most I can lose is 100% of my investment, because the cost of the option is your investment. So if somebody said to you, the most I can lose is 100% of my investment, that wouldn't sound so great, would it? But that, in fact, is what someone is saying to you when they're telling you the most I can lose is the cost of the option, as though it's not a big deal to lose 100% of your investment. Furthermore, the cheaper the option is, the more likely it is that you will lose 100% of your investment. In fact, most people who trade cheap options are exposing themselves to losing 100% of their investment in a very, very substantial and probable way. So let me give you a simple example. Let's take a look at Amazon this morning, which was trading at 682 at the time. And we took a look at the 740 Amazon call expiring the third Friday of December, the normal monthly options expiration. That happened to be trading for exactly $1 at that time. So if you wanted to buy this option, because everything in options is multiplied by 100, you'd have to pay $100 for this option. So let's look at the facts and figures around this option buy. You say, hey, it's only $100. Well, let's take a look at the realities around that options trade. It costs you $100. The delta of that option is 0.0568, which means that there is only a 5.68% chance of the option expiring in the money. In other words, there's a 94.32% chance that that option will expire worthless. It will be worth zero. Your $100 bill will be burnt up and turn into zero. So if you do the math on it, because a delta is really the probability of an option expiring in the money, you will lose, if you do that exact same trade over and over and over again, you will lose 17 out of 18 times. That's the math on it, okay? 17 out of 18 times, because the probability is so high of that option expiring worthless. It is, after all, a 58-point move in Amazon in 17 days. So therefore, you may do this trade 17 times in a row, and the likelihood is you will lose almost every single one of those times. So if you did this trade 18 times, you would lose $1,700 on the losing trades, and then you would make possibly some money on the winning trade, and that is only if the stock runs beyond the strike price to pay for the cost of the option itself. So it actually has to go past the strike price for you to even break even on the one that you have any hope for at all. So what it means is, if you do the math, you have to make a 1,700% return on the option that you win on to make up for all the losses of the options that you lost on. In other words, 17 times you'll lose, 1 time you'll win. On that one win, you better make 1,700 bucks up, or the whole thing has been a fiasco, and even then you're just at break even. So doesn't sound like such a great idea now, does it? I can only lose 100 bucks, but I could make 1,000%. If you make 1,000% on the trade that you make money on, you still will lose money on the campaign if you view this as a campaign. So next time someone brags about a 1,700% gain on an option, which really made him even on that option, made him break even on that whole process, and we're ignoring commissions here, by the way, ask him how many times he lost on that same option, and he's sure to change the subject. So just wanted to warn you about these kinds of concepts. To reiterate, when someone says to you, all I can lose is the cost of the option, that's like saying, all I can lose is everything. All I can lose is the entire investment. What investment are you going to go into where you are excited about losing 100% of it? And how many investments are you going to get into where 17 out of 18 times you will lose 100% of your investment? That's what everybody's bragging about. It makes no sense to me, and therefore buying these kinds of options to me is a losing proposition. Now, selling that same option, that starts to have some value in my mind and in the mind of most people who trade options, but that's for another day. So thanks very much. Hope that you agree that we've just debunked a kind of a silly concept in options trading, and what you should try to do is try to find those concepts that are sustainably profitable market after market, and that's the kind of thing we try to teach in the Options Tribe, and I hope that you get a benefit from that. Thanks very much, and we'll see you next week.